Alrighty, I believe the volume is all good. Just getting a few things sorted here, and then we'll get straight to it. I hope you're all doing well. Few things sorted here, and then we'll get alrighty. So what happened yesterday, let me just confirm. Nobody's in the chat to let me know the volume, so I've got to watch it myself. What happened yesterday? Yeah, volume's good. Alrighty. Let's go. To a 15-minute. Let's go to so what I'm annotating here is this daily stick week. Now I'll take off these standard deviations. So on this day, we had which was yesterday, 17th of December 2025, we had this massive candlestick to the downside. Now, I was sort of expecting this to occur rather than have it expand higher to this buy side, because we are going into the end of the year, and a lot of these people won't really be running companies and stuff, and this is all really AI generated, and bank holidays and etc. So the likelihood of the Nasdaq making an attempt to reach the all-time highs again wasn't really favorable. So I was looking for lower prices, and anytime I want to look for lower prices, what I want to sort of look for is PD arrays. Now, what are PD arrays? PD arrays are like gaps or candlesticks. A candlestick can be turned into a PD array if you divide it into, if you split the candlestick like we're doing to this wick. We're splitting it into quadrants, so the midpoint, the upper half, lower half, and high and low. So we'll go into further context and the narrative to why it was more likely to go lower, and how you can capitalize on going short if you have the higher time frame perspective in play. So the higher time frame, if we look from this high, so between these two price points is where my eye is sort of trying to see through. So, being an ex-carpenter, I would say that has made me very, a carpenter's eyes, once he sees how a home is built, any home he walks into, he sort of knows, and only a carpenter would know this. Only he would know the quality and the standard of how the work is done, whether it's, things being square or equal or whatsoever. But we're very precise, and this requires that sort of precision. It's not random. This thing is literally controlled from specific price levels to specific price levels. There's no messing around where it can go a little bit outside the lines, and that's okay. That's like the slab. No slab you see that's built, before the frame goes on, the slab, to be honest, I've rarely seen a concrete slab that's poured that's always bang on square. It's always a little bit outside the lines. Some places could be a little bit extra, some places a little bit whatsoever. And that's what this can do. It can shade a little bit outside the lines. But when the carpenter comes in to draw his lines up on the slab for the walls, that's when you get that precision element, and that's where the walls stand on. So that's where it sort of has a conflict between the two. And you're probably wondering, why am I talking about carpentry when I've got candlesticks up? It's pretty funny, right? So you get the point. So the precision of it being so precise that's what it is. And we'll go up to a weekly chart just so you can have a feel of what I mean by that. So this gap is a volume imbalance, right? So that gap right there, that's the volume imbalance. So that gap is, imagine like these, they're called studs. It's what actually, when you see, you know, the sticks, when you look at a frame that's being put up, and the frame that's being put up has studs, right? And sometimes when the studs are too far spaced, it's not enough, it's not efficient. So we need some sort of bracing or something to make it more efficient. And this is an algorithm that operates in that similar sense. So as this inefficiency, sorry, I had to pause there for a second because my mic was turning off. So as this inefficiency is created and it goes below it, it only has printed one candlestick. So I like to see these kind of inefficiencies or gaps get used at least twice before I disregard them. And I frame up this higher time frame narrative with how I'm going to look at on the lower time frame, and then at what time. So we'll get to that in a moment. So we'll go to the daily chart. That's the weekly volume imbalance. It's a bit in the way. Inside, right. Yeah, I like that better. So this is what it means by going just a little bit outside the lines, and that's because of that inefficiency right there. Now, see how it gets used here, and then it goes just over the lines? That's okay. Volume imbalances, this can be expected with volume imbalances, but fair value gaps, high time frame fair value gaps, or order blocks, especially order blocks, midpoint of those, which is this dotted line, are extremely sensitive. So you can see the midpoint here. This is on a daily daily time frame. Look at how many days it's spent inside of this. You got 1 day, 2 days. To use this same weekly in the daily. So this is where you'll go down into the lower time frame and identify where do you want price to go, higher or lower, and is it also time to do so, and what is the economic calendar looking like? So meaning, do we have high impact news? Is there going to be manipulation, etc.? So this is what the daily time frame, and this is what I have in perspective. Now, I don't want to have too much lines on the chart, but let me just fix this up. Where is this one? Yeah, here we go. Okay. So if we measure from this low to this high, and if we extend it to the right, These are our levels, right? This is our dealing range. So between the highest high in the last 40 days or 60 days or 20 days, that's how far I'm looking back. The rest of all this I don't care about. It's what's happening, and the algorithm only cares about what happens in the last 20 days, 40 days, and 60 days. So if we look back, this is day 1, day 2, day 3, day 4, day 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 17, 18, 19, 20. So this is the lowest low in the last 20 days, and this is the highest high in the last 20 days. If we go 40 days, then I'll get that high. So you can even measure from this high as well, and that's where you get that. But I want to measure this because before, this was the dealing range I was measuring off. It's much larger because this is external and this is external. Why is it external? Because this low was taken out here, and this high was taken out here. So that's the dominant buy side, that's the dominant sell side, and that's the minor buy side, which we attacked when we came up into there. And if you look at the levels, the bodies, this is what I was talking about. If you're the carpenter, right, when he draws on the slab with the chalk line and he flicks it, that's where the walls go up, and that flick from the upper quadrant has just been dominant of a reaction there, and that happened last week. So going into this week, when we see this, my perspective and bias meaning which direction I want to see the market go to, is it higher or lower, would be to the downside. So we can see the next draw for me would be, is price likely to go to the lower quadrant, or so look to identify any inefficiencies. I want to annotate them. So we'll make that yellow. We'll go like orange. Yeah, I like that one better. Text. So that's the volume imbalance. So why am I going to that wick? Because there's another gap here as well. So that's I want to refer to that level because it's going to the low of that candlestick, and that's the daily low. So that's a significant PD array as well. I want to extend that out forward, and when price gets there, does it want to react and go higher or attack that sell side? So I favor that sell side. It doesn't need to happen today. Doesn't need to happen. It could happen whenever, but when it does, so because I'm on every day, I'm constantly watching price. Throughout the day, I'll have a look, pop in, and see these things. This is what sort of repeats every day. So with this in mind, we have that potential area. So it hasn't quite got there yet, but we'll see it later on. Maybe could happen today, could happen tomorrow, could happen the next day. But ideally, I would like to see some sort of black candles deliver through this, and then that would be enough to say for now. That's almost, 900 handles. That's a fair bit of distance. But that's what I'm looking for, and that's how I see this. So we'll drop down to a 1 hour chart. Look at what happened yesterday. So this is a daily wick. Just remember that. And these were the weekly volume balances. And you can see the reaction when it gets to the midpoint there. 8 a.m. and then 10 a.m. just leaves it. Creates what? Maybe make this one. It's a bit too thick. This is a fair value gap. So this fair value gap is what's going to be the framework. This is what you want to see. Anytime you want to sell price, or if your bias is bearish on the daily chart and you want to see price go down, it is the best reactions are going to happen inside these fair value gaps at a specific time. And you're going to know that by looking at the economic calendar, which is Forex Factory, which is this. forexfactory.com. It's for free. Anyone can use it. You just go on it, and anytime you see red on any currency, you know that there's news at that time. And this is my local time, but my trading view is New York local time. So I'll always make sure that I know what time it is I live in Melbourne. In Melbourne, it might be midnight or 1 a.m., 2 a.m. But in New York, that's when it's really, really popping off. So the fair value gap will drop to a 5-minute chart. And since you know all these from the higher time frame, we've just broken it down. So imagine we've just completed the whole frame, and now we're just doing inspection work. This is what this lower time frame is for. We're inspecting and looking for any inefficiencies in price that need fixing. And when we identify that sort of gives us the clue of, okay, this is where the market's going to go. So we can see here the 1 hour fair value gap. The midpoint, it's going to be the most sensitive. And if you're really bearish, if you really want to see price go down, you do not want to see it get to the midpoint. At least close above the midpoint. You don't want to see it close above if it closes above the midpoint, it's the probabilities drop drastically. And this is all based on probabilities and how well you can execute based off, the very minimal risk. So we have here relative equal lows. This is what would be an inefficiency. If I was an inspector, I'd look at this and I'd be like, you need to fix this up. And that's what we see here. And this is the time I was referring to, 9:30 a.m., which is the equities open. This is all manipulation they're building up a premium to come down smart money and take these orders. Anybody that was buying here, it tapped into the 1 hour fair value gap. It doesn't need to get the consequent encouragement, and the time is where it's happening. It's more important than the price. So it doesn't need to get there, but the time, it's already there. It's already attacked the orders above this high right there, and then it sells off, not allowing anybody that's made money down here to exit their position. And then we have that daily wick. You can see the reaction of the lower quadrant there. That was Monday. Tuesday was really tough. Tuesday was absolutely very hard to navigate. There was maybe, I'd say during the London, there was a nice move there, and there was one trade I would have taken, and that would have been closed in about 4 minutes, and that would have been it. But you can see how anytime there's a day like this, anytime there's a day where it consolidates like this, expect the next day, if not that day, the very next day, a large range day. So this was a very small range, and a small range day happens after a previous large range day. So we have a large range day, a relative small range morning session. This is choppy compared to this, right? And then we create these relative equal highs, and this high I was seeing, does it want to get there or not? But because it was already at such a premium, and we've built up, this low is equal to that low. Where's my So imagine you're an inspector, or imagine you're a building inspector, and say I'm the building inspector, right? And I've come here to inspect this market. Anything immediately I'm looking at, now you also, because you're watching this video, this low and this high. So this is yesterday's, the previous day, so before this day starts, and each day starts at midnight. So this is Tuesday. This is the data we've collected on Tuesday. Sorry. Yeah. So that's 12 a.m. there. And that's 12 a.m. there. and this is Monday. So we can see Monday was a more of a large range at that 9:30. It was much more cleaner, and at that new day, once again, get the data from the previous day, and then that's how you sort of navigate through that. But when I'm doing this, I'm sort of looking for the last 3 days. The last 3 days, the high and the low of the last 3 days. So that's the highest high, and that's the lowest low. And then when the midnight opens, it attacks that low. See that? So it takes the previous day's low, and then during the London kill zone in the 250 to 310 macro, we then buy, chop around. This was absolute search and destroy, and this is not interesting to me at all. It's very boring. It's very hard. You can get caught and get your head ripped off with this price action. So we rally to the buy side. Now we wait for the time. You can see what it looks like in the lower time frame. So at 8:30 was down here. We came up into this fair value gap. Now the best entries and the best reaction, right now what I'm going to give you is like the secret sauce. Like, damn, if you have stayed for this long and have seen this, I'm going to give you this, and I've really been giving it to you throughout the whole video, but this specifically, the best reaction is going to happen during the second phase and third phase distribution. So what does that mean? We have this high, it creates relative equal highs, and then this is what you want to see form. You want to see this, and then you want to see price create equal lows. So these are also relative equal lows, and these are some relative equal lows as well. It's a lot of trading in there, and then it expands higher. So that low has got enormous amount of liquidity below it. So that's also a target for when we're looking at price up here. We are going to anticipate this low get taken out. So what happens? This is the first phase. Now a lot of people can get, this is a good trade, don't get me wrong, if you caught it up here during the 750 macro. This is an entry, and your stop loss could be above the wicks quadrant, and you can weather that. If you're not phased about getting in that, or this is highly advanced, right? For you to get in here, you've got to be highly advanced. And if you're not, when it displaces like this, it's done what? It's done a shift in market structure, because it hasn't taken out these lows, that original low. So when it does that, that's relatively equal lows. Ew. So those relative equal lows. So we have this high, this low. Where are the bodies? Let me show you for a sec what this is. So this week, these 4 lines, so I'll get rid of these. Get rid of that. So these 4 lines is the quadrants of this week. So that's the low. 25,463.50. At 9:10, which is the macro between 8:50, so 8:50 is here to 9:10. That's the window. That's the time where you're gonna. Is there a trade forming? And if you haven't got in between that window, you would wait. Well, that's really the window between 8:50 to 9:10, and then it can go all the way up until 10:10. And by 10:10, if you haven't entered anything or not already in the trade or managing a trade, it'll probably go to about 11, latest 11. 11:10, after that, I like to be done. So we can see this little fair value gap. Now, notice it comes into this. It creates relative equal lows, comes up, it wicks through the gap. This is what it can do. It can look scary when you're ready in from here. That's why getting in here is less pressure, because you can advance would be getting in here, getting out here, getting in here, and then riding it for the second phase distribution. From that high and low, we've come up, we've hit the midpoint. This is on a 5-minute chart, and then we've done what? The best what you want to see with these fair value gaps, you want to see it respect it and then create another fair value gap, and then use that one. So what's happened? We have, after it's traded up into this, and then it's opened up at 25,463 level, which is the low of the candlestick. This is the midpoint of that range. Let me show you. So this 25,411, that's the mid level from that range. $25,411. That's this one as well. So it creates another fair value gap. Now this one, remember what I was saying about midpoint, it's called consequent encouragement. The midpoint of the gaps, it's far more better if it doesn't get to midpoint. And this one, it didn't get to midpoint. And look at the time. This is 9:25. 9:30 is right here, where it hits the fair value gap one more time. It doesn't even get to the lower quadrant. So if you split the midpoint and the low in half, you get the lower quadrant. It doesn't even get there. And then it leaves it. Where that mid-level was on that higher time frame, it leaves a gap there. I don't want to see price come back to this level. It should not come back to 25,411. if I'm looking for that low at least. So you can see it, before it takes out that low, it never even gets to 25,411, and then it creates another gap. These gaps, this is where the source is again. If you've watched for this long, which at the moment, to be honest, I've got 0 viewership, but I'm here rattling because if someone is going to end up watching it, then they've deserved it. If not, well, I don't really care because I'm not really doing this. I'm just doing this because God has, I feel like God has called me. This is my calling. Like, well, I can't just keep this to myself. And if I can show this to you, and because I have it, I'm sharing this with you. I don't need to. I don't need to tell anybody about this. Nobody needs to know about this. I could stop tomorrow. But how I would feel would be it's just a different feeling. Like, I don't know how I'd be able to handle that. I'm not that type of guy. Anyways, sorry, I might go a bit off track here and there, but this is gonna take time, and this does take time, and this has taken me a lot of time, and I've had to put in a lot of money into this, and I don't really have to, this is like you avoiding me telling you how to avoid getting shot. And so this is simply what it is. So it creates that. Now we want to see these gaps. So, but Alex, you said you want to see the gaps fill in and get the midpoint and then sell off. Not when it's spooling. When it's spooling like this, it's already accumulated. First phase, second phase, third phase. It doesn't need to come back into these gaps. Just comprehend that for a second, what I just said. It doesn't need to. So, why? Because the accumulation, the first phase, second phase, and third phase, and if you had watched back, further back in this video, you would have heard me say that. So, what do we go off then, Alex? If I couldn't enter the trade, and up here, if I'm waiting, what can I use? Well, then you use the wick. So these gaps, if they stay open, which you want them to stay open because it's already done, smart money has already done the accumulation, then they don't want any more people making money on the buy side. So they're going to drop this thing as low as it needs to go for them to be satisfied. And you've seen how low it's went. So this wick, I'm going to zoom in for you. So that wick, that's the one that didn't get to the last wick. That's what creates the fair value gap. So that's a PD array. So I'm going to measure that. And that quadrant, look at the reaction. So if I don't want to see it get up inside the fair value gap, which means take that candlestick's high out, I'm going to go off the wick, and you can see the reaction of the premium wick. Now once it gets to the premium, what does it do? It goes down, closes, opens here, trades up, doesn't get to the upper quadrant, the lower quadrant, sorry, and then trades all the way down, and then comes up, closes here, and then this candlestick opens, it trades up through the upper quadrant, down, and then here's where smart money is setting the bait. Look at this low, look at this low, and look at this low. Those are relative equal lows. So I'm going to try and look for a PD array to go short because of that higher time frame. So we have now left the midpoint of that daily time frame. Where is the next draw? The very minimal would be the lower quadrant. That's the target. That's the idea. Doesn't mean it has to get there, but because that's a lot of points. Doesn't mean it has to. But as long as it's in that direction. So we hit the upper quadrant, and then here at 10:20 it hits the midpoint, and then time again 10:30. That's another dramatic time, or just an incredible time to be trading. That's when these markets are going to run. So you can see that 10:30. Once it gets there, this candlestick fails to get there. So you can measure this wick, and you measure this wick, I bet you it's not even getting to the upper quadrant, and it's just wicking the halfway point of this wick. And then what does it do? Attacks that low. It's under new investigation. It's seeking new liquidity. It's going to expand to the next draw, and then after an expansion will come another consolidation. So we have this expansion. These gaps I don't want to see fill in, not yet. If I'm bearish, I don't want to see them fill in yet. So it breaks away. That's beautiful. We want to see that. The next candle breaks away. Beautiful. We want to see that. Now there's this little gap in there. I'm not really interested in that one, but it's there. And you can see the body, it goes above it here, and then it uses it there. Which is, I'll show you what it looks like. So it wicks it there. Order flow still bearish. We don't want to see it go up to this gap. You can measure this wick. Why this wick? Because this is the wick that went into the fair value gap. Tell me that this is not specific, this is not precise. If I was a building inspector, you have just now experienced a master class of the building industry. I've just given you the whole blueprint, and I've given you the map, and I've spoken to you in the language that's required for you to understand this. And it was all done within, I don't know how long we've been live, to be honest, but you get the point. The midpoint, beautiful reaction. Once I said why this wick, because that's the wick that went into that gap. So they're the ones I want to be measuring off. Not all of these. I want to go back to that one. And then what does it do? Attacks the sell side again. And then the end of the day, which is a 3:50, 4 o'clock, it shuts. So by the end of the day, you've already caught the bulk of the move from up here. We were selling. That's 700 handles if we measure that roughly. Yeah, 16. Now, if you knew or had any idea about this beforehand, if you do watch this, even a thumbs up would be appreciated on the video. That at least I know, my time here wasn't a waste, and hope you really learnt something. And we can see, you know, after an expansion, expect this consolidation until it's ready to move again. And that's what it's all about, timing. I appreciate you all. Thank you for watching. Have a lovely Christmas. This is your Christmas present. And my Christmas present to you, although it's not real money or a gift, but if you really use this and apply this, that it will probably be the best Christmas present you will have ever received in your whole lifetime. And you can't change my mind about it, because I know it is. Thanks for watching, and once again, have a blessed Christmas, and hopefully I'll see you all in the new year. Take care.